Having had all this, next thing we're going to see is going to be your cash flows. We're going to have timeline here. We're going to have, just call it years, all right? We're going to call it years. Okay. We're going to have year 0, year half, all right? Year half, which is 6 months, and year 1, year 1.5, 18 months, and year 2. Okay, now this is going to be simply 6 months. This is going to be 12 months, 18 months, and 24 months. This is now. What we're going to have here is dinar cash flows. Yeah, first step is forecast your foreign cash flows first. Dinar cash flows in million. Now we're going to calculate without bringing in any capital expenditure. We're not bringing in any working capital to make sure that we can calculate tax easily. We'll bring in all that working capital and capital expenditure after the computation of tax. Now we are told that there is a revenue. Yeah, we are told there's a revenue in this paragraph number 11. Yeah, in this paragraph number 11, we are told there's a revenue of 500 million dinar, 1,000 million dinar, 2,000 million dinar, and 1,500 million dinar. Now make sure you have an extra column if you had a tax delay. Yeah, if you had a tax delay, you got to be careful here. Tax delay would be in year 3 timeline. Yeah, if there is a tax delay, you would have been a year 3 timeline, and your complications of tax, half year and 1 year, you have to be very careful. Yeah, but in this case, it's not a problem. It's not a problem. If it is going to be half year and 1 year, then your tax delayed by a year, you're going to be careful that there would not be any tax paid in this particular year. So these two will be combined to pay in year 2. You have to be careful with this point. Yeah. So in this case, it's not the case because tax is paid in the same year. Now you have variable cost. Yeah, variable cost. And we are told that the variable cost in paragraph number 12, that's going to be local labor cost, which are estimated to be simply 30%. Yep, it's going to be simply 30% of the revenue. Here, it's going to be 30% of the revenue. Now, if it's going to be 30% of the revenue, you got the revenue here, so you just multiply by 30%. 30% of the revenue, it's going to be simply 150, and they tell us this includes inflation. These are all nominal cash flows. So it's 300. 30% on 2,000 is going to be 6,000. 30% on 1,005 is simply going to be 450. And what we're going to have here is we're going to draw a line to make sure we have taxable cash flows. This is going to be my taxable cash flows in dinar, which is going to be 350. It's going to be 700. It's going to be 1,004. It's going to be 1,050. Next, you have to go back to that paragraph to discuss how many percent tax is it going to be. Now we are told that the tax here is at 40%. Is that clear? The company tax in the Canadian government is charging us 40%. So the tax is going to be at 40%. 40% of 350, you calculate, is going to be 140 Zananian dollar, and you're going to get 4 times 7 is 280. 4 times 14 is 6 and 5, 560. 40% of 1050 is going to give us 420. So we have done that. Now if you got capital expenditure, then you may have this capital allowance and all that. Now capital allowance, in this case we do not have a capital allowance here, so we do not have to add back any capital allowance. Or you can also say that you don't have a capital allowance, so there's no savings in capital allowance. So make sure you're aware of these methods. Okay, but in this case, so far so good, no problem. Now you got tax at 40%, and we're gonna have this thing now. Bring in, now when you bring in all your capital expenditure and working capital and all that, capital expenditure is mentioned in paragraph number 12. Yeah, capital expenditure is mentioned in paragraph number 12, and it's going to be at 1,000 million dinar. Okay, so we're just going to bring in all this are still in dinar cash flows. So it's going to be 1,000 million dinar. There you go. And you're going to get this figure closed off. There's no working capital. If there is a working capital, make sure you know how to deal with working capital, initial, incremental, and the recovery. Okay, so you're going to have this thing called net cash flows, which is going to be $1,000. Then you're going to have here $210,000. This is a gap here. Okay, it's 350. Sorry, 350 is going to be positive. Yeah, 350 is going to be positive. Minus of 140 is going to be 210. This is going to be 420. This is going to be 840. Minusing it off, you're going to get 630. Okay, you're done. You're done the first step. The first step is to change all your, to find your cash flows in the foreign country, in the foreign currency. And we have paid tax. That's good. Now we're going to come back home. When we come back home, you need to change this to exchange rates. Now the exchange rates is going to be the exchange rate that we have determined just now. 196, 217, 243, and 268. You got that just now, all in line for you here. So this is going to be 196, 217, 243, and 268. So you have it there. Done. Next thing, you have to be very careful here. Yeah, you have to be very careful, just like your past exam questions. I think there's one question in, can't remember, I think it's June 2011. The name of the question is Cassiopeia. Yeah, you go and check that out. Similar set of questions is being produced here. 1,000 is an outflow. Now if that is an outflow, what you must remember here, that this is going to be 150. Why is that 150? Because for you it's going to be in payment terms. You are going to make that payment. Because you're going to make that payment, you have to take the low rates. Buy low. You're going to buy dinar. Yeah, you're going to buy dinar at 150. So what you're going to do here is you're going to get to divide all these rates. When you divide, you're going to get the net cash flows in million in dollar now. All right, it's going to be in dollar, and if you calculate it properly, it's going to be divided by this. You're going to get 6.67 in negative. This is going to be 1.07, and you're going to get 1.94. You're going to get 3.46. You're going to get 2.35. Okay, all this is in dollar. So you have in dollar. Now you have to worry about the next step. The next step is you ask yourself, do you have any implication to domestic cash flows? Do you have local tax? In this question, no. Did we receive any royalty income? In this question, no. Do you have any management fees receivable? In this question, no. Do you have any loss of contribution? No. Do you have any contribution as a result of this project in European country? Like for example, sometimes this company will bring their raw material to Zanadia and do the business. So what's going to happen is, let me show you. Europe, Zanadia. Sometimes they will bring special component. There are a lot of questions on this. They'll bring special component to that country to do business, and they're going to transfer price. Yeah, they're going to do some transfer price where your cost may be $3 and they're going to sell it to them at $7. So they're going to make a contribution of $4 in this country. So we will take this $7 and we will initially build that up in the cash flows of Zanadia. We will translate this to Zanadian dollar and we will show that as project cash flows in Zanadia. That means to say, let me show you. If you have that situation, then you would have brought in that raw materials, the raw materials that you have bought from Europe, and it should be at $7, and you're going to translate all this at the relevant rates, relevant exchange rates back to Zanadian dollar. Okay, then the implication will be, in Europe there will be a contribution of $4, and this $4 need to be taken into account net of tax. This has to be taken into account net of tax, and that is when we will show here if there is any, but in this question, no. So that's it. Next thing we're going to do is we're just going to simply discount this at 12%, which is given in that paragraph, risk adjusted calculation. There you go. Can you put in the discount rates? The discount rates at 12%. This is going to be 1. This is going to be 0.893, and this is going to be 0.797. You can use your table, or you can just use 1 plus r to the power of negative n. This is going to be equals to 1 plus r to the power of negative 0.5. Okay, so you're going to get 0.945. The same way you do this, it's going to be 0.844. 1.12 negative 1.5. Negative 1.5. You're going to get this rate, and when you multiply, everything else is going to be at present value, and it's going to be in dollar. 6.67, 1.01, 1.73, 2.92, and 1.87. These are the answers you should get. You can pause the video and make sure you get the correct calculations done, and you're going to get an NPV here. We're going to get an NPV here. we're going to get an NPV at positive $0. Yeah, $8.6 million.